You called the direction. SPY moved your way after the event, and you still lost money on the weekly call. That is not bad luck, and it is not you doing something wrong on the entry. It is the pricing machine working exactly as designed. Quick note before we go further, this is educational commentary, not personalized financial advice. I am going to show you the mechanism, and once you see it, you cannot unsee it. Here is why this matters right now. Every few weeks there is a scheduled catalyst. A CPI print, an FOMC decision, a jobs number, a megacap earnings release that drags the whole index. Retail traders load up on cheap-looking weekly calls the day before, convinced a big move is coming. And they are often correct that a big move is coming. The problem is that everyone knows it is coming, and the option price already knows too. So let's name the wrong belief out loud because a real trader holds it. The belief is, big move equals big profit on the call. If SPY jumps 1% in my direction, my call prints. That prediction feels obvious, and it fails constantly. The missing piece is that you did not buy a piece of SPY. You bought a piece of volatility, and volatility is the thing that collapses the moment the event is over. Let me make it concrete with one contract in small numbers. Say SPY is trading at 500 the day before a Fed meeting. You buy one weekly at the money 500 call. Because the event is looming, implied volatility is elevated, so the call costs you, say, $5. That is $500 of premium for one contract. Now watch what is actually inside that $5. That price is not random. The options market has already computed an expected move, roughly how far SPY is likely to travel through the event, packed into the implied volatility. If IV is pricing a 1% swing, that is about 5 points on a 500 index. The market is effectively telling you we already expect SPY to move about 5 points. You are not being handed that move for free. You are paying for it up front inside that $5 premium. Now the mechanism nobody explains cleanly. Implied volatility is high before the event because of uncertainty. The instant the announcement drops, the uncertainty is gone. The number is known. So IV collapses, often violently, and that collapse drains value out of every option almost immediately. Traders call it IV crush. Think of it this way, you paid for a storm, and the second the storm hits, the forecast is deleted from the price. So here is the real break-even, and it is the sentence to remember. You are not betting that SPY goes up. You are betting that SPY goes up more than the market already paid you to expect. If the expected move is 5 points and the stock moves 5 points, your directional gain is roughly canceled by the volatility you lose. To actually profit, the move has to beat the number that was baked into your ticket price. Let's run the tape on our example. The Fed announces. SPY rallies 1% to 505. You nailed the direction. But that 5-point move was exactly the expected move already priced in, and IV just got crushed from, say, 30 down to 18. Your 500 call is now in the money by $5 of intrinsic value, but the extra volatility premium you paid, that other chunk of your $5, has evaporated. You might be flat. You might be down. You were right, and you did not get paid. Now change one thing. Suppose SPY had ripped 2% to 510, double the expected move. Now intrinsic value is $10, which swamps the volatility you lost, and the call is a clear winner. That is the whole game in one comparison. Same direction, same event, wildly different outcome, decided entirely by whether reality beat the expected move, not by whether you called the arrow. There is a second-order trap here too, and it is skew. Before big events, out-of-the-money puts often carry richer implied volatility than calls, because people pay up for downside protection. So when traders reach for cheap out-of-the-money calls to play a bounce, they are frequently buying the option with the least favorable payout structure, then getting crushed hardest on the volatility side. Cheap in dollars is not cheap in probability. So here is the aha that reframes everything. When you buy a weekly option into a known catalyst, the market is not your opponent guessing the direction. The market is a bookmaker who already set the line. Your edge cannot come from knowing a move is coming because that is in the price. Your edge can only come from believing the move will be bigger or smaller or in a different shape than the crowd priced. Direction is free information. It is worthless. So what does a disciplined trader actually do with this? First, before any event trade, they pull the expected move straight off the option chain, roughly the price of the at-the-money straddle, and ask a blunt question. Do I have a real reason to think the move beats this number? If the honest answer is no, there is no trade. Second, they respect that long options into a catalyst are a bet on magnitude and timing, so they size tiny, because IV crush can make you right and still zero the position. Third, if their actual view is that the move will be smaller than priced, They flip to the other side of the machine and consider being a net seller of that expensive premium, defined risk, so the IV crush works for them instead of against them. Same event, opposite structure, because the edge is in the mispriced volatility, not the headline. This is a process example, not a recommendation. The point is that the question changed from what will happen to what is already priced. And this transfers well beyond SPY. Single stock earnings, biotech data readouts, crypto around a scheduled unlock, any moment where a date is circled on the calendar and everyone is watching. The rule is identical. On a known event, you are never paid for being right about direction. You are paid for being right about how the move compares to the price. Carry that one question to your screen and you will skip most of the trades that quietly bleed retail accounts. If that reframed how you look at an option chain, subscribe, because signal beats hype every single time.